So good afternoon, everyone. Thanks for joining us for the fall 2017 IFA FBN meeting here in Seattle. We've got a good group of people here in the room. We've also got about 40 folks attending via webinar online. I'm your host, Josh Piper. I'm from Dorsey and Whitney. I'm the co-head of the Franchise and Distribution Practice Group here. Happy to be your host along with Dorsey and Whitney. If you've been in this area involved in franchising for recently for any amount of time, you know that before this year, Gary Duvall from Dorsey was the host of these events for years and years and years and years. Not to date him. But what some of you know and some of you may not know is that Gary intends to retire at the end of this year. So he wants to say a couple words, but before he does, I just wanted to extend my personal gratitude to Gary for what he's done both for me personally and for our community in this region. I think it's safe to say we wouldn't be who we are or what we are without his leadership over the years. So thank you, Gary. You want to come up?
I'll come up because I want some of the people I know on the webinar to hear.
Yeah, you can. They won't hear you unless you're up by the phone. Yeah.
Yeah, that's it. Okay. Well, thanks, Josh. So yeah, I want to thank everyone for attending, including those in the webinar. They're coming from as far away as Denmark this time. We have a number of Canadian attendees on the webinar as well. And as Josh said, this is going to be my last FBN. I'm retiring at the end of December after 40 years of practicing law. I have this cup in my hand. It's a gift from the IFA for hosting these, and it's dated 1994. So that reminded me that I started this in Seattle in 1990. And as in so many things, in giving back to the industry, you actually get more in return. And I've just been very grateful for the information I've gotten over the years, the learning I've gotten from the speakers, and the network opportunities. And I look forward to Josh hosting these in the future. And thank you, Josh, for doing that. And I also look forward to Danelle and Josh carrying on my franchise practice capably. I just have one more thing to have you help me with, which is I'm cleaning out my desk and I have hundreds, if not thousands, of these business cards. So come and get one, and I'll autograph it for you. Thanks. Thanks very much.
So a couple quick housekeeping notes. So these FBNs are put on in conjunction with the IFA, the International Franchise Association. They are, in fact, a benefit of membership. I think a lot of people in this room and online are members. It's a great industry organization. There's a lot to get out of it. If you aren't a member, whether you're a franchisee, franchisor, or supplier, and you're interested in finding out more, come see me afterward. I'm on the membership committee and can give you some information about it. And then directly after this meeting, we're having a relaunch of our local women's franchise network. There'll be a brief meet and greet after. It's being co-chaired by Gina Johnson here from Business Alliance and Danelle Wolf from Dorsey and Whitney. So if you're interested, please stick around after to meet with them. On to our program. The topic today is a question that most prospective franchisees ask, a question that most franchisors and brokers are a little bit nervous about answering, and something that existing franchisees are continually asking as they develop their business, and that's, how much can I make? And it's really about sharing financial information with candidates and with existing franchisees. And we're going to tackle it in three parts. First part will be sort of the franchisor's responsibilities for providing financial performance representations to their candidates. Then we're going to go to the franchisee and broker side and sort of get an experience of how franchisees are dealing with receiving and not receiving financial information. And then we'll talk about how franchisors can capture and leverage the data of their existing franchisees for the benefit of the whole system. Our speakers will be myself, and then we'll have Jeff Levy, who is a coach, author, and educator. He's been doing that in the Seattle area for 15 years. He's recently the recipient of the 2017 Visionary Award for the Entrepreneur Source Broker Network, which he's associated with. And last but not least, we have Barb Nuss, who's the owner of Profit Soup, which provides business owners and managers with practical tools, techniques, and education to give them greater control over their financial future of their companies. Thanks, Jeff and Barb. So on to our program. Well, one other housekeeping note for questions. We do want to try and save them for the end for the folks in the room because we do have them available for the webinar folks, but we'll only be able to get to that at the end of the program from that laptop. So if you can, try to save your questions for the end. So the first topic, financial performance representations. What are they? We do have some folks online and in the room who are new to franchising, so I thought I'd start with a little bit of the basics and then before diving into some of the recent changes. Financial performance representations is kind of a mouthful. In the beginning, we used to call them earnings claims, which is kind of a more intuitive term of what we're talking about, is a statement about what you can make, how much earnings you can get. But the regulators thought it wasn't comprehensive enough, so they gave us this clunky term, financial performance representations. We in the industry usually talk about them as FPRs, so that's what I'll be the term I'll be using. What is an FPR? It's under the current FTC rule, it's any representation, whether it's oral, written, in some kind of visual form, to a prospective franchisee that states expressly or implicitly a specific level or range of actual or potential sales, profits, income, etc. So it's any kind of way you might answer that question of a candidate, how much money can I make? Just some quick examples of an explicit statement, pretty obvious. Hey, you can earn $10,000 if you buy this franchise. An example of a more implicit statement, you can get 100% return on your investment. There's an innumerable number of variations on this, but these are a couple of examples of what an FPR might look like. So why should you care about this topic at all? One, if you're involved in franchising, you're going to be coming across FPRs more and more and more. There's been a huge increase since 2008 in their use among franchisors, not only in the number of franchisors that are providing them to their candidates, but in the variety of FPRs that are being made. Franchisors are starting to get creative with what they're putting in their Item 19. What's driving this is the market. Franchisees are demanding them, or put another way, franchisors that are providing FPRs to their candidates are finding that they're having more success in their sales. And in fact, today more than 50% of systems are providing FPRs, whereas 10 years ago it was probably 20% or less. So it's just going to keep increasing over time. You should also care because FPRs have to be done correctly, or there are potential significant consequences for franchise sellers. Doing them right is complicated. The rules are complex. You really need to work with a skilled advisor to put them together correctly. And there can be significant liability if you don't do it correctly if you are a franchise seller, and that includes, or could include, some of the brokers that we have with us today and online. So it's really important to know what we're doing. So again, more basics. What are the key requirements for making an FPR as a franchisor or a franchise seller? First, you have to have a reasonable basis for the information provided. I'll talk in a minute about what that vague term means. You must have written substantiation for the FPR, so you've got to have some documentation backing up whatever representation you're making about finances. You have to disclose what your material assumptions, your bases are for making that FPR. So that's usually like the number of locations you're including, the period of time you're measuring, any specific characteristics about those locations. And then all of that information has to go in a specific place in your disclosure document, Item 19. Or put another way, if there's nothing in your Item 19, you cannot make any kind of FPR to a candidate. So that's kind of the basics. So what is a reasonable basis? As I said, it's kind of a vague term. There is no statutory definition other than what you see there, reasonable basis. And that makes a little bit of sense because it's kind of, there are, like I said, many, many ways that you could develop and formulate an FPR, and it would be pretty impractical to try and create a rule that would address each of those. There is guidance from the FTC and the what we call NASAA, or the North American Securities Administrators Association. And those give you some guidance on what you have to do. They give you some guidance on what is not a reasonable basis. But even if you comply with everything that they say, that doesn't necessarily mean that you have a reasonable basis to make the representation that you're going to make. Now, about a week and a half ago, there was ABA, American Bar Association Forum on Franchising. And at that event, which brings franchise lawyers from around the globe, there's usually a regulators panel. So state regulators come in and they talk about their view and what they're finding. And so they addressed this topic a little bit, so I thought I'd share what their perspective is that they shared. When they're looking at FPRs that come into their states, they want to see that the figures that underlie the representation are based on the results of the actual system you're selling that have been recently achieved in that system. So it's not a hypothetical, it's not somebody else's system, or it's kind of a related system. It's the results of the system that you're selling. And then kind of more interestingly, the results should be possible to achieve in the future for franchisees that you're selling to. Now, they were clear to state that they of course don't want you, they're not saying make a representation that you're guaranteeing that franchisees will make that level of sales, but it just needs to be possible for some hypothetical franchisee to achieve the sales that you're talking about or the profit that you're talking about. And they frame that in sort of two ways. One, it should be based on the franchise models that you're offering now, that you're selling in that disclosure document. So if for some reason you've completely revamped your system, your locations, you're using a different format, you probably don't have a reasonable basis to make an FPR on systems that aren't formulated like the ones you're currently selling. Similarly, if the economics for your particular industry have changed, maybe there's new regulations, something that has fundamentally changed the economics for your new franchisees, you might not have a reasonable basis to give them financial information on franchisees that the results weren't under those same economic conditions. So that's sort of how regulators are going to be looking at your FPRs when they come in on whether do you have a reasonable basis to present this information to your franchisees. So now on to some of the recent updates. NASA, which I mentioned, is an organization that promulgates rules and commentary for all the state franchise regulators, and they use that to implement their own state regulation of franchises. They adopted a new commentary earlier this year specifically on FPRs. It becomes effective. It depends on your system. The language in the commentary is kind of convoluted, but here's a little shorthand way to figure out whether or not you have to comply with it or when you need to comply with it. But for all intents and purposes, most systems who had good advisors already started taking this commentary into effect with their 2017 renewals. So most have already started using it. But if you haven't, here's a kind of a handy shorthand way to figure out when you need to comply. One important thing to note is as you go through state registrations and you've got an FPR, you're likely to see increased comments on your FPRs because of this new commentary. If you get a comment on your FPR and you implement that change, there's a presumption under the FTC guidance that change needs to be implemented in all your other registration states. So then if that's the case, then you need to make a determination on whether it's a material change, which might require amendment filings in all of those states, so it could potentially be kind of an expensive process. Hopefully you only have to go through that once as this commentary rolls out, but just know that if you are making a change to your FPR for one state, there's a presumption that you should make that for all your registration states. So I'll run through some of the highlights that are new in this commentary. Quickly and easily, there's what's called an admonition that's required by the FTC. We always knew what the language that needed to go in your Item 19, and Item 19 is the part of your FDD where the FPRs go. But it was always supposed to be clear and conspicuous, but we didn't know what that meant. Now we know it should be a separate paragraph, bold type, no other formatting, and no disclaimers or waivers like you can't rely on this information, which you would find in FDDs. However, you can, and you're encouraged by the FTC to find other alternative ways to explain the information that you're giving, explain your assumptions and bases. And if you do that, and it tends to narrow your disclosure, and so it serves a similar risk mitigation function to having a broad disclaimer. And you can work with your advisors to sort of figure that out. Second, if you use averages in your FPRs, so our our franchisees in our system average X level of sales. You now need to include a median because averages can be skewed by outliers. You also need to include the top and the low number of that set that determines the average. And then finally, if you are removing from that set, that universe of outlets, outlets that close during that year, because their sales, they don't have a full year of sales, so you probably want to exclude them. That's fine, but you need to disclose specifically if any of those had closed within 12 months. The regulators are concerned that maybe you're excluding them as a way to hide poor performing outlets. Subsets are a pretty common feature in FPR, so you've got your whole universe of outlets, but you're just making an FPR based on a subset of that whole system. It's generally fine as long as you have a reasonable basis, it's accurate, it's not misleading, just like any FPR. You do need to explain why you're doing it, and make sure it's not misleading. There's a couple of limitations. First, you can't have a subset that is solely based on financial performance. So that's typically what you would often see is our top 10% of units average X, or our top 10 locations do X. That's no longer allowed. The only time it is allowed is if you include a corresponding low performer disclosure that sort of help offset that. So you probably will see these disappear because a lot of systems don't, they don't want to, they like the high but they don't want to report the low. So you might see those disappear. Sometimes franchisors will do quartiles, and so this helps them keep that quartile disclosure so they can report their top quartile, second, third, and fourth. And then one more limitation: you have to have at least 10 locations before you can use a subset. So if you've got a small number of locations, you really need to just report all of them and not create a small subset out of them. One of the big areas of guidance in this new commentary was whether you can use your company-owned data only in making an FBR. So you've got a system, you've got your own units, maybe you have some franchise units. Can I make an FBR just on my company data? I have high confidence in that data. Can I just give an FBR based on my information? If you are going to consider this, make sure you work with your advisors and look at the commentary. There are specific definitions for some of these terms that are important to help you figure this out. One of the most important is operational franchised outlet, which means a franchise location that has been in operation for 12 months, or at least 12 months, or one season if you have a seasonal business. More importantly, make sure you are defining your financial terms in an item 19, so your gross sales, gross revenues, what have you. In a lot of systems, it's very specific for that system, the carve-outs that you make from gross sales. So make sure you're defining that term in item 19. So can you make an FPR on just your company data? If you want to make a gross sales or gross revenues FPR, and that's it, you can't just use your company data if you have operational franchised locations. So if you've got even one location that's been open for 12 months, you have to include basically that franchised outlet in your FPR. If you don't have any operational franchise outlets yet, that's fine, as long as you have a reasonable basis to make it, and you describe any material differences between your company stores and your potential franchise stores. If you want to do a gross profit or net profit FPR, that is fine on your company stores. That's fine. You have to have, like all FPRs, a reasonable basis. You need to include your actual costs. So you would have your company store's revenue, your actual expenses for your company stores, and then you need to adjust that for basically any expenses that franchisees are going to incur that your company stores don't incur. So obvious things are like a royalty, maybe an ad fund, technology fee. Some back office support might be more expensive for franchisees, so you need to take your company information and adjust it so that it more accurately reflects what a franchisee can expect. And then as a final caveat, if you do have operational franchise outlets, you also need to include their gross sales figures. And then last update from the commentary, can you merge your company data and your franchise data? You can, but you do need to first report them separately, and then you can combine them after that if it's even useful at that point. There's one exception, is if you have a small number of units, and reporting your franchise units separately would basically allow you to figure out, okay, they've got 2 franchises, here's the sales figures. I can correlate those, and I know that this business has this level of sales. That's a little bit too much information that you might not want to share about a particular location. So until you have more than 10 locations, you can combine it all together so that you're not unfairly disclosing information about your franchisees. And then lastly, at that regulators panel a couple weeks ago, the regulators conveyed some issues that they're seeing recently in the FPRs that they've been looking at, so I thought I'd pass that along. First, surveys of franchisees. Apparently a lot of systems are starting to use those more. The most important thing the regulators talked about is making sure that you have a sufficient response rate from your franchisees to make sure it's representative. And these are typically surveys they want, you're looking for expense information so you can make an accurate net profit or gross profit FPR. The example that they gave that they thought was laughable was a system that had 200 units and they had a 9% response rate and tried to give an FPR based on that. So it's probably not enough, 9%. So something more than that. You should have reasonable confidence that the information that you're getting on those surveys is accurate. Certainly no information that it's not accurate. And then no better source of information. And this is really, I think, is aimed at gross sales. So if typically you're getting gross sales directly from the POS system or some accounting system. So take the information from there rather than what the franchisees are reporting on their survey. You can use the expense information on the survey, but if you have a great source for gross sales, use that instead of what the franchisees are giving you. Combining information is another potential or an issue that has been popping up, and that's really a problem if the locations differ significantly in their results. The examples they gave were first like a service franchise where you've got some franchisees that have multiple territories, and you've got some that are single territories, and you're lumping them all together as sort of an average of what all our franchisees are doing. If you pull them apart and you see a big difference between those two, you need to separate them and report them separately. Same thing for systems that have different kinds of locations, like say a kiosk in a full-service restaurant. Those results of those are likely to be different, so you need to analyze them separately, and if they are indeed different, report them separately. There's a lot of differing factors among locations. A lot of them are fine to lump together as long as it's reasonable and you explain it. Real quick, the FTC rule has a lot of specific information that needs to go in your FPRs, like how many units achieved an average, the percentage that achieved an average. Work with your advisors to make sure you're disclosing all of those. There's been a lot of comments lately about franchisors missing those. The admonition that we talked about earlier, and then also, like we talked about, defining your terms, your financial terms. And then last and importantly, FPRs in advertising. These are, just like FPRs in general, these are becoming a lot more common. You didn't used to see it a lot, but you open like a Franchise World magazine or Franchise Times and you're seeing a lot more system advertising where they're talking about gross sales or gross profit. It's like any other FPR. It has to be reasonable, truthful, substantiated. There are some specifics from the FTC rule, so work with your advisor to make sure you're including that. There's a similar type of admonition that needs to go in there. That your sales you might not do this well. The details supporting that FPR have to come from your item 19, just like any FPR. And then this last point, what's most interesting to me, is that any information prohibited in item 19 is also prohibited in advertisement. For example, only disclosing the top X percent. I think it was like a year ago, I was flipping through a number of those magazines, and I would see quite a number of those, like our top 10% achieved this level of sales. And so I think I don't see that as much anymore, so I'm guessing this view of the regulators is starting to get out there. But it was kind of interesting. It's not necessarily totally apparent from the commentary, but the view of the regulators as they see it when they're looking at your FPRs and your ads. So that's it for FPRs and franchisors. And now I'll turn it over to Jeff for the franchisee and coach perspective.
Great. Thank you very much, Josh. As thank you. It's a pleasure being here. And my title today is is coaching franchise candidates in financial performance, or as they ask, how can I predict the future performance of my business? And it's sort of an interesting discussion. I think some of the comments that I will make they'll all be from the coach-broker perspective, but I also think some of the comments will relate to people that are salespeople directly working for your franchise if you are a franchisor. But not all the comments will be the same. So when I meet with a client, this is what is on their mind, and I think this is a universal discussion or a universal beginning point, whether you are a coach broker or a salesperson representing a franchisor. They expect, and again, there's a naivete, I believe, that you have to meet them where they are, but they will expect that a franchisor is like going into a bank and seeing a list of certificates of deposit, and if I invest so much, I will get so much back. Well, we all know that's not true. They expect you to be transparent. They expect that income and return on investment performance will be available somewhere. They want to know, where is it and why are we hiding it? They know somebody has the information. They expect franchise salespeople will answer direct questions. Now, I'll take just a short segue on that, is that if you're a franchisor, you have to train your salespeople to not sound like they're trying to hide something or trying to be obtuse, but to explain why they can't give certain information to people. You'd be amazed how many candidates get turned off when a sales rep for a franchisor just says, well, I just can't tell you, and without a little bit more support. People come to me and say, give me the highest financially performing franchisors. It's always tough. I obviously can't do that. So after I sort of wrestle with them a little bit, we get to the question of, how do I start to get projections so that I can make an intelligent decision for their business? As Josh said, and when I started 15 years ago, a very small percentage of franchisors were giving these FPRs. FPRs? Mm-hmm. Yeah, we call them earnings claims. And what I found is that when I started looking at them, I found that even that information was not particularly helpful. And I even believe today that when I work with a client, I will tell them that the FPR is not by itself a reason to make a decision to move forward with a franchise. Now, oftentimes it represents the company stores. I think it often omits some local circumstances, and they give you wide ranges. So, for example, rent in Seattle is going to be different than rent in Albuquerque. With 15 now, our wages are totally different. I think someone mentioned to me the other day that they found out that in the business there are finder's fees or referral fees they have to give out, and they said that wasn't listed in the FDD as part of a cost of doing business. So we learn every day. I also understand that earnings claims need a definition, as you're saying, because oftentimes they're sales, less gross margins, and they're really not addressing in detail the costs in local markets. They don't speak to the cost. They typically speak to they don't speak to, what's below the cost of goods line, if you're familiar with the typical P&L. So my position with clients as sort of a coach broker is that they have to build their own model. And I'm sure I'll make this point in my talk in a few areas. I am really, really careful that I am not the expert in the franchisor that they're working with. Even though in the state of Washington they consider the broker part of the chain of commerce, we are considered a sales agent for the franchisor. In my view, I know Charlie would feel the same way, we are really not. So our role is to try to help the client get the information, not give them the information. And our role sometimes is to say, what did the franchisor say to you, hear what and hear their interpretation, and then hear what the franchisor sales rep says and says, are these people communicating? Are they making progress? So business planning, what I do, again, from the broker-coach perspective, is I work with my clients on business planning, and it's a discipline. And I'm fortunate enough that in my background, I moved here in the early 80s before there were PCs and started working with startup companies, and I did business planning on a piece of butcher block paper with a 36-inch ruler and a pencil and an eraser. So I know fundamentally the disciplines. And I also know what an assumption is in a business. And an assumption is the most educated guess Well, yeah, it is an educated guess based on the best data you can find and your own personal experience. So what I'm working with a client to do is let's go on a mission to find information. And FBRs are one component, but that component is just part of you building your business model. And I've gone so far as to suggest to a franchise candidate, get to the franchisor, ask them if they'll give you a template, a working a working Excel spreadsheet with the formulas in. They're not going to give you the numbers, but they're going to give you the working documents so that as you gather information, you can get the numbers and you can put them in. And then we can, in our world today, there's reality and there's fantasy, and a good plan passes a smell test of reality. So these prospects need data in an environment that really restricts data on what to do. And I will tell you, I think I've probably helped close to 300 people sign franchise agreements this day, most in this community. And I can tell you not one of them has ever signed an agreement without a very strong feeling that they have a good working plan that they're going to execute. So how do we, what do we do? How do we get there? So again, from the coaching mindset, I try to get the client to say, you're already the CEO of your own company. You are the president of your company. You have to husband your time. You've got to protect your assets. But you have to seek information and not be afraid to ask for it. I want them to understand whatever the item 19 is, and I don't defend it. Clients ask me, will I look at the FDD? And this might surprise you, and my answer is no. They might say, will you evaluate the disclosure, the financial performance disclosures? I'll say no. They'll ask me, will you look at my business plan? And you might think that I'd say yes, but my position is that I've never run this business before. I am not an expert in the dry cleaning business or the residential cleaning business or anything else. But what I'm going to do is make sure that you know where you can go and to get information. And when you get information, we're going to give it a smell test. Does that make sense? Can you validate it and compare it to what other people are saying? So I mentioned I'll suggest that the client get a worksheet from the franchisor. I also very strongly recommend clients don't go out talking to franchisees unless you've gone through a series of discussions with the franchisor so you know what to ask. You can't say to somebody, is this a good business? Most people will say yes, or if they say no, then you don't know where to go from there. I don't know if this goes over the line of the law or not, but I will say to my clients, ask the franchisor if they will give you the name of franchisees who are particularly fluent in financial data, that do a good job in understanding the P&L, and send your worksheets to them, and let's see what they say. And oftentimes we get tremendous positive constructive feedback, and the franchisees in the system are not held to the same standard as the franchisor is. I'm not shy asking that a franchisor tell my candidates, who are the best people that might know real estate or might know labor handling, etc. I also try to remind the client throughout the process that this is a business, and a franchise basically is giving you a toolkit. They're not giving you a guaranteed return. And so this is a little bit that's really important for them to understand. Otherwise they get in the business and things get tough, and they don't realize that it's their responsibility to implement the toolkit. And then we talk about the educated risk versus calculated reward. So I think I wanted to get done fairly quickly because you've got a lot more good stuff to deal with. But I'll be here to answer questions, and I will tell you that the key in terms of coaching people is to make sure they're not making decisions based on that shiny object up there, that they objectify the business with a solid plan, and oftentimes they have to do it themselves.
Great, thank you, Jeff. So I'm Barbara Ness, and my company's called Profit Soup, and our specialty is around financial benchmarking, helping franchise understand where do you get this information and how can you use it, not just for the FTD, but also to create better performance in your network. Because in fact, that is the ultimate goal, right? We're here to make better businesses. If you do a super job at developing information and sharing information with your franchisees, you already have all this information that you need. And as much as it sounds pretty onerous to to check all the boxes that Josh outlined and all these different ways that you have to slice and dice the information and prove this. If you're really a great franchisor and really committed to profitability in your network, you've already done these things. The question is just how much of it am I going to share, and how strategically does it make sense to share it, and what fits with the requirements for sharing information in the disclosure document. So what I'm going to be talking about today is capturing good financial data and then leveraging that to, in addition to providing information for franchise candidates, but to building a better, more successful franchise network. The same information that you need for your FDD is even more necessary for the ongoing operations of your franchise. So the basic stock of what it is that we have to work with is that we get our information from franchisees who are not financial people. And that is one of the things that we know in most franchise organizations that I work with. The franchisees struggle with the number side of the business. Now, that's not universally true. There are a number of franchise concepts that attract people that are, ex-financial management people. But most of the concepts that I work with actually attract people that are nurses, or that like to walk dogs, or that are mechanics that think they would be good at changing the oil, or they're salespeople, but they're typically not people who were financial people in their past life. I think the reason for that is financial people don't have any guts. And they already know that the numbers don't work out, so they're not going to do it, So what we really need is people who have good guts, because entrepreneurship and real success comes as much from intuition as it comes from the numbers, about being good risk takers. It's just that we have better intuition if we have a basis for the numbers, okay? So, but what my experience is that the owners, they don't come to the table with this. They don't have very much management information experience, and for that reason, they don't commit to having good information within their own franchise. So they don't value it as much. It's not where they came from. And they don't, maybe if you're not good at something, when do you do it? Well, you put it off until later when you have time, and you're busy enough that you can easily make it so that later never comes. So we end up with a bunch of franchisees that have garbage for information. Now, I'm not saying universally that's true, but the basic stock is that is from a franchisor's perspective, I'm trying to collect information to share, to say how great my franchise network is. And I know that my franchisees have put some other expenses through here for things like the gardener and the babysitter and whatever else is running through here. And so now do I want that to be a part of my FDD? So what then happens is that the franchisor even starts to discount the value of the information. And what is required to make the information good is a good solid recipe for collecting and analyzing financial information. And what happens is in franchise agreements, there's almost always is a requirement that they submit financial information, like financial statements, sometimes every month or every quarter, but at least every year. And most of the franchisors that I know don't enforce that requirement. And so that's a really important place to start, is by getting good financial information. If you don't ever get over this issue of what your basic stock is, it becomes very difficult to put forth good information in item 19. So to me, the answer to how do you have great information that's reliable, that will help people make decisions like Jeff described, it's really about having a culture in your organization that drives business improvement, and having good metrics is fundamentally the basis for that culture. And when I think about what it takes to do that, it really comes from the top down. Now, I talk to a number of people about benchmarks because they hear about what I do. And we have conversations about this. And frequently the franchisor will say, oh, well, I benchmark my information. And I say, well, tell me more about that. Well, we get our sales from our royalties and we share average sales. Now, that's very different than somebody who collects full financial statements, including a benchmark, every month through an online technology and platform and charts people's performance. Both of those things are benchmarking. but there's a whole bunch of degrees in between them. And some don't share any system-wide information at all. Others share a lot. I find that most share at least sales, and even within their, I'm talking right now about within the franchise organization, not what goes into the FDD. So what do you have that you can share? They all have sales information because the royalty is based on it. And they're all motivated to have franchisees sell more, and so frequently we'll benchmark that and even show how one franchise compares to the other, and we'll give awards and things like that for sales performance. Some will go a little bit deeper, and whatever it is in that, if that's in their point of sale system or their CRM tool, there are usually a lot of metrics there. For example, if it's a CRM tool, they might have the number of leads. You might have the number of web leads that get appointments and the number of appointments that become jobs, and look at conversion and closing ratios. Those are critical things to benchmark if you can. They don't necessarily go to the FDD, but geez, if they did, wouldn't Jeff's job be easier to help them identify, could you get from point A to point B, okay? So there's a wealth of information that you could collect. I recommend start by saying, what do my franchisees need to know to drive success? Because that's what we should be measuring and sharing with them. And then worry about the FDD later. Worry about driving a great franchise first, and the rest will come. What I'd recommend that you do is you listen to what our conversation today, that you consider making a list of the metrics that you currently do collect in your franchise network if you're a franchisor. Which of them do you actually share? Because usually there's a bunch of information you have, and then there's other information that you share. And how often do you share it? And then there should always be this inventory. You have this running list, and you have in your mind, what else should I be adding to that list to help people succeed? That's your obligation as a franchisor, is to share the information people need to help them succeed, and everybody wins, because why are we here? We're here for one reason and one reason alone, and that is to build piles and piles of cash. And what I suggest you do when you decide what should you measure is think about, what does it take to drive business value? Because piles of cash in a franchise is really, for a franchisee, is about driving the value of my individual unit. And piles of cash for a franchisor is about all your franchisees building the value of their individual units. So what's good for us is also good for them. When I think about what to measure, this is kind of a profit soup approach to looking at business. Everything starts with sales. Like, nothing happens until someone sells something. And so you start by measuring sales, not just sales, but the activities that drive them. And if you do that efficiently, we call that productivity, right? So sales drives productivity. When I say productivity, what I mean is, how efficiently do I get sales from my resources? And now for each type of franchise, the resources may be different things. Almost universally, one of the most important resources in any franchise organization is the team, it's the employees. So how many people does it take to drive the sales on average? And that helps Jeff assess whether that labor cost is efficient there. If we know that on average, how many people do you need for how many sales per employee do you generate, we could back into how many people you need to get to a specific level. Then you can figure out what is the cost per employee. Then you can figure out your labor stuff. So it's all there. The other important resource, depending on the model, might be inventory, if it's a business model that carries inventory. It could be equipment, if it's a equipment-intensive business. So you have to think about, what are the resources that it takes to really drive success here, and what do I have to manage well? That's what you should be measuring, is how efficiently you manage that. And if you do measure those, and if you manage them well, it's going to drive two things to happen. It's going to drive profit, and it's going to drive cash. And notice the lines go opposite directions, because they are not the same thing, okay? So we need both profit and cash to survive over time. But you can do a really good job at driving a profitable company, but if you never collect your receivables, you aren't going to have any cash, okay? So you have to be mindful of all of that. If you do a good job at managing the profit of the business and the cash flow, that drives what we call financial strength. Okay, what's financial strength? That is, a company can pay their bills when they come due, and they borrow money wisely so that they can create a bigger, more profitable company, and go on and on and on. So it's about being efficient with debt in very much, financial strength is, and having debt for the right reasons, not to make up for bad decisions or good deals gone bad, but to leverage your ability to grow in the future. If you do these things right, and you can measure all of these things with metrics, if you do these things right, it grows the value of the company, it grows the value of the franchise, it grows the value of the franchise network, it grows the value of the brand. And so these are the things that we need to measure and to share to drive a great business. Now, we still need to decide which of these would we share in the FDD, but you've got to have them just to drive a great business. So I'd ask you to ask yourself, have you defined what should be measured in each of these areas? Now go back to that list. What do I measure and what should I share? Am I really measuring the things that drive productivity, that drive profit, that are the drivers of cash flow for my business, and financial strength? So those are really critical things to be mindful of, and have that be as a part of your, as a franchisor, it's part of your responsibility. So now, how do we get this information? The stuff to measure the profit side comes from an income statement. The stuff to measure the cash side comes from a balance sheet. So that means we have to collect financial information from our franchisees, okay? Now, enter the question, just how much time do you want to spend analyzing bad data? Because many of them don't have very accurate information in their books, and that it's not really a secret. We know it. And so the question is, what are you doing about it? What are you going to do to make it more accurate? I believe it actually starts with education. People have to know why they should keep good records. People have to see what's in it for me and how I can use this information to make bigger piles of cash if I just did it in this way. So a few suggestions that I have in keeping it accurate. First of all, get started early. Have a standard chart of accounts. Have some good policies, just like you have on your marketing and your operations. You should have in your operations manual how they should, what are the minimum requirements that they should have for what they look at to manage their business. The chart of accounts is how we keep our books, as you know, which sales buckets do we have, which cost buckets do we have, and if you're ever going to get benchmarks for a system, it really helps if they're all keeping it the same way. If you're starting a new franchise, it's way easier than if you have one that's already 20 years old and everybody's doing it differently. It's hard to get people to change and to begin accounting for it in the way that you want them to. If you have regular financial reviews as a part of your model, not only at the franchisee level, but at the franchisor level, you start to create a reason why people should do it the way you suggest. Because if they did, they'd have better information, they could make better decisions. So really, once you get the information from them, you have to realize that some of it's going to be wrong, and you have to look for it. You have to look for the errors. And I use data integrity routines when I do financial benchmarking to help identify the things that could be wrong. I'm not going to dive into each of these in the interest of time. It's all there on the slide. Happy to talk about any of this stuff about how we actually do this for many of you. But you'll find that the same stuff is wrong every time. So why not make a checklist that has that checkpoint in it that says, make sure this is right before you send it to me. The other thing is that when it comes to what's in it for me and sharing information with your franchisees, less is more. I think a half a dozen metrics that covers off on that whole big picture is probably better than 27 metrics. And so think about what are the real most important drivers of success. I also think that a picture is worth 1,000 words, and that if you can have dashboards that really show where they are, comparison to others, it's a little speedometer thing, that really helps intrigue people, especially those who are not financial people, which is most of your audience. How you gather that information, you'll need to make some technology choices. If I'm a franchisor and I want to get information from my franchisees, the very easiest way to do it is say, send me your P&L and your balance sheet at the end of the year. And they send whatever they have. It's usually a PDF form, sometimes it's an Excel sheet. That's the easiest, simplest, least expensive, and you get this stuff at the end of the year. Then you've got to manually do something with it. The more sophisticated franchisors are going to start with a technology solution, and like the top two on this slide, one is where the franchisor can reach in and pull stuff out of their financial system. The other one is where the franchisee at the end of every month or week or quarter or something pushes a button and pushes it up to the franchisor. Important distinction, actually. If you're pulling data, you don't know if they've fixed it yet. So you could really be pulling junk. They could have not posted everything. So unless you know that systemically it's error-proof, you probably don't want to pull it until you know it's good. If they're going to push it electronically, you're going to want to have some education in place that says, how do you make sure your stuff is good before you push it to me? They can also, at the end of the year, fill out forms, which is kind of the in-betweener place. But if you're going to want to benchmark monthly or quarterly, you're going to want probably a push or pull situation because it's too time-consuming to do it manually. So if you have franchisees that keep good data, you're a good candidate for those top two. If you know it's a disaster, you might want to walk before you run and do something less complicated. And we can certainly help you assess that and choose the right way to move forward. Josh talked about subsets. How do you segregate that data once you have it? These are real common ways that I think are useful for assessing franchisee performance. I think age of company is in there as well. What I find with the age of company is it usually tracks pretty close to sales volume categories. So if I take my young companies, they kind of tend to be the same companies as the ones that are under $500,000 and $500,000 to $1 million and over. It kind of tracks. Sales volume kind of tracks with age, so I don't usually do both. But some other ones that I think are important to assess corporate initiatives. So say the management team has decided that, or the executive team has decided, rebranding exercise, man, everybody needs to change their store to look like this. And some of them have done it, and some of them haven't done it yet. And what's the success rate of those that implement versus those that don't? Those types of slicing and dicing of the data can help validate whether you were on the right track. Things like, did they choose that marketing package or this marketing package if you offer things that way? And look at the results based on the choices that they make, or whether it was a kiosk or a shop, or whether they adopted the premium version or the next level down version. These things not only help the franchisees to identify what good performance looks like, they tell the franchisor whether you're on the right track. And sometimes they say, you're on the wrong track. This stuff didn't work like you thought it was going to. And a mature franchisor has to be able to look at their data and see if it's actually causing them to rethink their reality, and maybe it's revealing some blind spots. So the benefits of benchmarking are pretty easy to see. We've talked about them already. The franchisees want to know what's possible, but having those milestones gives them feedback about whether they're getting there. And if you've designed your metrics so that they know which ones to look at that drive success, you'll put them onto a pathway of success. I will say that it's useless to do all this if you don't do the education. Financial education is probably actually a bigger part of my business than financial benchmarking, because without the education and knowing what to do with the information, you can't make strong implementation. So I'll just kind of close by just sharing with you what I think makes a successful benchmarking initiative. Commitment at the top from the executive team, the field support, and the franchisees. Find your flag wavers. Make sure people take it seriously and do a good and that we're doing a good job on it. And it's not something we did once so we could check the box and move on. We're committed to a process. It's not an event. Don't be afraid to face the problems that it shows, because benchmarking frequently does reveal blind spots. Inherent truths that you were just sure were the case in your network, sometimes the numbers just don't show it, and maybe you had a blind spot. And will you commit and respond to that? And the other thing that makes them successful is if you pay people, i.e. your support team, for making sure you get good information in. So the most successful franchisors I've seen with financial benchmarking initiatives had their support team accountable for making sure their franchisees submitted their information, and it was a part of their bonus package. It's a part of their compensation package that unless you meet these metrics at getting this percentage of them in, you don't get your bonus. So I will tell you that I do have a course, 8 Steps to Better Benchmarks, on Profit Soup Online, which is really cool that Profit Soup Online is now qualifies for Certified Financial Executive Credit, which is new. And so are all of our most popular accounting, or not accounting, but financial and financial management courses are also accredited for CFE.
Certified franchise.
What did I say?
Financial.
Certified Franchise Executive, thank you. Right, that's it. So I think we have a question slide. There we go. And you can...
We'll open it up for questions. Yeah, you can come down to the table. And if you're online, feel free to type your question into the chat box and we'll read it out loud. Any questions from the audience here in the room? For anyone?
So Jeff, what if you're not getting expense information from either franchisor or franchisees? Are there other sources of information, bankers, accountants, SBA?
Yeah.
Can you repeat the question?
Yeah. The question is if the client is not getting information from the franchisees or franchisor. So, and typically, if they're not, I mean, that's the foundation. So if they're not, then it's likely they're not going to move on, or it reduces the chance significantly. However, over the years, I've developed a lot of third-party ways of validating public information. So, for example, using the libraries or using other research data or other resource books to say, do these numbers make sense? Even commercial realtors today will do some hot mapping for someone as to what their demography looks like in a territory. So, but if you don't have the foundation, and if the franchisor doesn't have some degree of openness, I think it even speaks more to the culture rather than the fact that they don't know what they're doing.
I think I would add that there's a number of industries where you can find industry information and benchmarks out there. There's a number of sources. Your CPA firms can usually help you find that information. Many CPA firms belong to data warehouses where they actually submit their clients' information. But I think it's still a leap of logic to think that the franchise would have the same results, because in theory, the franchise has a different model. We're better because we're a franchise, and that's not reflected in that information, in that industry information. The special thing about your concept that makes you better than just opening on the street something similar is not reflected in the industry data.
We must have done a wonderful job.
Actually, we've got one question online here. As the franchisor, we were advised by our legal counsel not to provide a blank Excel doc with the formulas to candidates. Do you have any comment on this? I think it depends on what else you are providing with that. If they're, certainly if it's got filled-in information, that's certainly an FPR. I mean, you could provide one if you've developed a full-fledged FPR and it's in your item 19. But I think what they're talking about is just here's a blank Excel sheet with our sort of formulaic P&L. I think best practice is not to provide that anymore. I think past franchisors would do that. But the question I've gotten most often is, we've got a gross sales FPR. Can we also provide pro forma that then kind of gives an idea of expenses, and that's sort of now it's sort of backing your way into making then a gross profit or a net profit FPR when you haven't included that in your item 19, and that's where a lot of systems can get into trouble, is doing a gross sales and then on the side giving a pro forma. So
Yeah, my personal, of course, non-legal opinion is that I think it's overly conservative to not provide a blank spreadsheet with line items, because those line items are already in the FDD, so somebody can just take them and put them over. It's more of a convenience issue, and I can't think of any stretch of the imagination where that moves into the realm of an earnings claim. When you say, haircuts, rent, etc. So I still would likely encourage my clients to push up against the franchisor and ask for it.
I think the place where it runs into trouble is if in the formulas you put rent 8% of sales, because that's our system average. So if you build formulas in like that, if the formulas you've built is total sales is sales bucket 1 through 8 summed, well, there's probably not a lot of danger there. Right. But if we're building assumptions into it, which is actually what we want, but if we're building the assumptions into it, I think you're really running into trouble.
Right. Gary?
Yeah, so I think that's a really interesting point, because there's a real disconnect between the question and what's done. And they seem like they're opposites, but they're really not. The reason the lawyers are saying don't do it is more a question of proof. We're frequently asked by a franchisor to defend them from a claim that they gave unlawful FPRs. They weren't in the item 19. And then we asked, why did you do that? And they said, no, we just gave them a blank form. So if you're a franchisor and you're going to give them a blank form, you have to be willing to prove and able to prove that it was truly blank. So it's a matter of proof. And the franchisee later, it'll be all filled in, and the franchisee will remember that it was the franchisor's
form.
And the franchisor will remember, no, it was. So there's ways to prove that. You just keep a copy of the email, what you sent them, etc. So yes, it's a dangerous practice, but no, it's not unlawful.
Yeah.
As long as you're willing to prove it. So they're both right. The questionnaire is right, and you're right, Jeff. This time it's a yeah, exactly. That was a good suggestion. Steve said, keep a copy of your email, ask for a response back, acknowledging that they looked at it, it was blank. And you just please confirm that what we sent you, it was blank, and you get an email back, yes, it was blank, and keep that,
in the file.
If you're willing to go through that as a franchisor, then you can do it.
Yeah. We're 3 minutes past our time, so I'll conclude the webinar portion. There was one comment just from one attendee that for the franchisors, it's important that the franchisor and their team motivate to prospect franchisees to reach and have communication with the current franchisees. So I think it's asking franchisors to encourage their network to provide information to prospects. So we'll be around for in-person more questions, but we'll end the session now, and thanks everyone online for attending.
Thank you.